She expects the AI rally to continue to broaden out to non-tech sectors. Joining us now, Savita Subramanian, head of equity and quantitative strategy at BofA Securities. Usually you come in, you're on set. I guess it's easier down in the city. But thanks for joining us, Savita.
No time to commute. Yeah, no, great to be here. Yep.
Are you, in terms of, we've been expecting this with AI, some of the as it broadens out when these things are so richly valued at this point, are these things you're talking about going to be beneficiaries of AI or down the supply chain for building out the AI, or both?
I think a little bit of both. I mean, where we're seeing this sort of AI train go, I mean, it's obviously stopped at power and utilities, and we've seen a big, re-rating in some of those stocks. And now I think it's moving into more of the areas around tooling, industrials, getting all the generators into those data centers that need to be tooled up at this point. We're also seeing really interesting use cases of AI that have been helping margins of some of the more labor-intensive areas within healthcare. We just upgraded healthcare from underweight to overweight about a week ago on the premise that it's seeing less margin risk. It's actually one of the sectors where the use cases around AI helping efficiency are really, really abundant. Our analysts have written a lot about this theme. So I think there are, kind of different areas of the overall economy that could benefit. When I think about the potential victims, I think what's disturbing is we are in an environment where one of the biggest contributions to consumption growth over the last few decades, i.e., white-collar services, professionals in that age bracket of 25 to 45, that group it's harder and harder to see jobs. You're seeing less new jobs created in that cohort. So I think that the consumption story becomes a little bit harder from here, and we're starting to see that in some of the data. So that's something I would watch, and we just downgraded consumer discretionary from overweight to equal weight.
Savita, we've had a couple of people come on and say, yeah, things are good, earnings are going to be pretty good. But this time around, with the move we've seen since the April and May lows, I mean, it would have to be like blockbuster to move it from...
Right, exactly, exactly. Yeah, I think that's right. I think the bar is really high today, and this is happening on top of, the market cap to GDP of the S&P 500 just hits a new record high every day. Well, except for today, I guess, so far. But, it's a really, really expensive market environment where I think the problem is we're not necessarily seeing a lot of risks priced in. Meanwhile, we have this information vacuum around government data. We have to kind of guess at what's going on. We've got this potential for, some of these hyperscalers are getting more asset intensive. They're starting to see, kind of higher depreciation expense. That usually comes with a lower multiple. Some of these companies are raising capital to spend on CapEx, and historically what we've seen is that's a recipe for underperformance, not outperformance. Of course, I'm not knocking the ROI on these AI projects, but I think that there's something kind of different going on in the market today than what we saw coming out of that post-Liberation Day swoon.
So, Savita, you're bearish near term. Is that fair to say?
Yeah, our year-end target is below where we are today. We're at 6,300. We're looking for, kind of continued positive returns for the market over the longer term, but really more from a broadening of performance. And what I worry about is we've seen some more tariff uncertainty, some more policy uncertainty, and what that did back in April was it created a little bit of a pause in terms of companies committing new capital, hiring people, kind of business as usual. So if this is creating that same type of pause, I worry that that could push out a broadening of the market, into 2026. So, yeah, that's what we're watching.